Um, okay, good thing that happened in the last week. We had the debt ceiling raised, and last week we were saying there's a 99% chance that would happen. But one thing the stock market likes is certainty, and it does not like uncertainty. So whenever you have a big unknown, like a debt ceiling crisis, if we ever default on a debt, that will blast the stock market down 25% or more. And that was like an edge case that might have happened, but it didn't. But right now it's almost like a relief rally. So we were looking at, in our notes last week, we were saying, a catalyst for the market going up is a debt ceiling deal. And if that was reached, which it was, removes the uncertainty. So we have interesting things happening in retail sales this week. We had companies warning that there's going to be a bad, like for instance, we had Capri. We followed that before. It's a manufacturer of clothing like Versace and Michael Kors. They went down a lot because of retail demand. And now Lululemon, they said that retail is doing good. So we have kind of a mixed bag with retail, with some consumers pulling back. Dollar General went down 25%. We never really followed this stock, but it's a trade down for maybe a recession that might happen. But it went down 30%. And so we have retail like going all over the place. Target's a mess because they have people stealing from their inventory, and that's causing issues with that company. And so right now what we're concentrating on is we're basically near the end of the Fed tightening cycle, and that's good for growth stocks. We had a really good earnings report today from not earnings report. We had good news from the job market. The number of jobs that were added. Look at this, stocks rally after jobs report past expectations. So they were basically double what was expected, new hires. And that means we just have this translation. Whenever you have a good job market, that's an indication that the economy is doing well. And that means we're not going to go into recession. So I updated this calendar. I said, this could be the time we go into a recession, and maybe July is when we go out of the recession. And we're basically, it doesn't seem like right now we're going through a recession. So we're looking for, that's really good for the stock market. So that means recession means stocks usually go down 10 or 20%. But it looks like the economy is doing well, even when there's interest rates are going up. So I took the recession notes out of here, and it looks like let me see. We have another meeting on June 14th for the Fed. They'll probably raise rates another time because of this job report. And right now, that's why I put, because they're going to raise rates, we're super overbought right now, the stock market. I mean, every week it gets a little more overbought. You see back here, we were following this downward channel until right here. We had, this is S&P 500 we're following here. And by the end of today, we'll be at the upper end of this channel. So we've been making higher highs and higher lows. So that's a very good indication that we're in like in a new bull market, basically. These are all the moving averages. The 50-day, 100-day, 200-day, and the S&P is actually trading above that right now. And most stocks are starting to trade above their moving averages. And that's an indication of a momentum in the stock market. So I guess the lesson learned here, we went through a whole last year of negative 30%. I mean, negative, almost every stock we're following was going down. The key to remember is eventually there's a switch whenever stocks start moving up again, and there's like a momentum that starts to build, and you have to really understand that to really get a hold of where the next bull market starts. So right now we're basically in this channel. What I did for every one of these charts we're following, I made a sideways channel, and I made a channel going up or down that basically says if we're flat on earnings, then we're going to be going sideways. But if there are really good earnings that come out, we're going to follow this upper channel. So right now we're at the top end of this S&P. So it's pretty dangerous to invest right now because everyone's excited. We have bullish momentum. I'm 100% invested. I've been 100% invested for a long time. I'm not going to be selling or buying based on this. But if I have new money to put in, I would much rather wait where we're oversold to buy some more. All right, so that is the overview. And June is traditionally a bad month. So if we look at the stock market averages over time, June is one of the worst months. Then we have August, September as the next worst months. We have a unique situation right now where we have some possible end of the tightening. We have a lot of momentum in the market. A lot of the big tech stocks are rallying, and that's causing the rest of the market kind of to follow them. Right now, the 10-year and the 2-year are up since last week. They're down, actually, no, they're down from last week. And that's because whenever there's a debt ceiling thing that's not a problem anymore, people aren't going to be afraid of buying those short-term investments anymore. All right, so let me see. What else do we have to see here? Okay, so the other things we have to look forward to in June, we have another holiday coming up, the 19th. So Juneteenth holiday. So people will be, I put like a green area around that. So we have to look. Actually, the holiday worked out pretty good for Memorial Day. The market was good before the holiday and after. So I expect the same thing to happen after the next holiday. And we have end of quarter window dressing at the end of this month. So I marked that with the purple. And let me see, what else do we have here? All right. So one thing to remember about this end of quarter window dressing and the June time frame, the stocks like the NVIDIA that went up a lot, like almost doubled or doubled or more since the beginning of the year. A lot of hedge funds and mutual funds are going to be tacking that to their portfolio. That's the end of quarter window dressing, but they might be getting into it now. So that might carry all the stocks that went up from the beginning of the year a lot farther, just because they wouldn't look good when their top holdings are showing. Let's look at some of the. Okay, this is there's a new term for the FANG stocks. It's called the Magnificent Seven. I don't know who made this up, but the largest tech companies are up this year, and these are all stocks we've been covering, so that's really nice. But right now we have Apple up 37%, Microsoft up 38%, and NVIDIA up 159%. So we have a lot of outperformance from the major tech stocks. And a lot of times these stocks that make up most of 25-30% of the S&P, that will help the other stocks go up. Actually, if you really look at the whole market, the whole market is, I mean, other than the top 10 stocks that are large cap tech stocks, most of the market isn't doing that great this year, actually. So this momentum in these stocks might help the other stocks in the S&P 500 and in the stock market. So, but you have to remember, right now we are everyone is bullish, everyone is greedy. We have AI mania. This reminds me of when people were really excited the market crashed. So right now we have kind of fair valuations for some of these AI stocks. Like Microsoft is really reasonable. And we went over NVIDIA last week. I did an update on NVIDIA's earnings, and they went up 4% earnings estimates. So they're gradually going up, but not that much. So they're still overvalued, but a lot of the other speculative AI stocks are pretty overextended right now, I think. All right, so let's look at...
that's why I shared AMD's PE.
Oh yeah, let's look at that.
So I had asked, like, oh, why did NVIDIA go up and like not, AMD or something? And AMD has gone up. it's also like double.
Yeah, let's look at the AMD statistics. AMD got into this AI with the deal with Microsoft. Microsoft and I think it's Microsoft and AMD are collaborating on new chips for AI. I guess Microsoft will provide is it Microsoft that's working with AMD? I think it is. So Microsoft will provide some AI. Maybe the stack idea comes that. But I've heard people that are really qualified on this subject. They say it's not really that much of a competitor to NVIDIA right now. But let's look at their statistics. AMD went up like 30% in a month. They almost like 4 PE. That's not that bad. 4 PE. It's trailing PE is 628. Whoa. So it looks like we went over AMD before. Didn't look that great for earnings estimates. Maybe things changed a lot recently. I don't know. It seemed kind of sketchy and expensive last time we were revealing it. This better be really. Let's look at the earnings. See what they say here. Earnings projections. These are supposed to be consensus estimates, but best I can do right now. Okay, let's look at this. Okay, so from last year to this year, it was down. They were actually losing. They were declining in their estimates. Let's look at see if it makes sense. So we're dividing. What we're doing. We're going here. We're dividing 286 by 413. That gives us the growth rate for the year. So 286 divided by 413. That's 30% from this year to next year. Let's do 4 divided by 5. 22%. Now 5.25 divided by 8.35. That's 38%. So something's happening between 24 and 25 that growth. So maybe it's when all that AI kicks in. I don't know. But still, I'd say if you average it all out, it's around 20% growth. And let's look at the PE of the stock. You said it was, let's see what E-Trade said, 608. Wow. And that's a lot. So I would classify this as really hard to invest in because you're throwing it. It's like it's kind of speculative right now. The numbers that we see here, 628, right? PE, but the forward PE is 42. That doesn't make any sense really.
It's a lot of growth. But you're looking at you're betting that it's going to deliver that growth, but that growth is pretty priced in.
Right. So even let's say the PE is 42, which is the forward PE. That's next year's earnings. So 42, they're still only growing like let's say 20%. That's still 2 times overvalued. And if you look at their profit margin, that's not that great. And then return equity is 0.72 right now. This is an example of one of those stocks that you're paying a lot for future earnings, not for what they're earning right now. So this could drop like in a heartbeat if there was a bad news story. And that's why Warren Buffett wouldn't invest in something like this, because it doesn't have like a track record. Let's look at just the just to we're going to do Narrow Edge. See, we're going to look at their past track record. I'm sure it's all over the place because I looked at this before. I mean, it's a pretty unreliable stock. Okay, it's not getting on me in, so we can't do that. But I guess the chip industry is pretty unreliable, and we can. And even looking at their earnings from the past, you can see that they're not very predictable. You don't see a straight line up. I don't know. Jim Kerner likes this stock a lot. I just haven't been able to put together. Even if it's a PE of 42, it'll take 3 years for them to start earning and growing at 40%. So for me, this is like an iffy stock right now. It's not as reliable and as consistent as some of the other ones we're following. So I guess we can keep going on this. What I did do since the last meeting is I went to E-Trade here and I looked at NVIDIA because they came out with earnings. It's good to review the stock a week after the earnings and their talks come up because a lot of times they upgrade their earnings estimates. And right now, it's almost $1 trillion in market cap. The PE is 200, if you can believe it. I don't know.
So what's the forward PE on that then?
Let's look at the forward PE using Yahoo Finance. This is a little more reliable, I think. It's almost there. Let's look at forward PE on NVIDIA. I'm thinking it's around 40, but let's look. Forward PE 84. Wow. Since it started going up, now it's at 84. So it better be growing at 84% a year. It basically, wow. So there was the dean of valuation was on CNBC. He was saying that NVIDIA he sold a portion of his portfolio because of his NVIDIA stock because it would seem like it's overvalued. So what I'm going to do is I'm going to look at, we're going to look at the earnings estimates. And I looked at this compared to what was there last week, and I see just 84% every year increase in earnings estimates. That doesn't really justify, a stock going up 25% or 40% in a week. But it's a buzzword. It's AI. It's their chips are powering the next infrastructure for what could be the next internet. So we'll watch these estimates, see if they go up and try to make sense of it. Right now, it seems like it's overvalued. So whenever you're investing in growth stocks, it's really good to have an understanding of where they're going to be competitively years from now. And the biggest problem with chip stocks, like NVIDIA, Intel was the biggest chip stock in the 80s and 90s, right? And it's hard for chip stocks to maintain their moat and to maintain their edge over everyone else, because every other company like Intel and AMD, they're coming out with AI chips. And NVIDIA's customers, they're looking for alternatives. They don't want to pay the sky-high prices that they're paying now. So it's really hard it's hard for me to invest in a chip company because I don't know where it's going to be 5 or 10 years from now. That's probably why you don't have Warren Buffett investing in these. Because we look at the track record of a company over time. Like for instance, we're looking at I did a little report on Lululemon, and you can see over a period of time that they're growing their earnings, and the chip stocks, it's pretty unpredictable because you have competitors like AMD. They came out of nowhere and they overtook Intel, and now we have NVIDIA as new competition. So it's becoming really hard to buy and hold a chip stock because of that. I think we can just keep our eyes on this for now, and see if these numbers actually change dramatically to adjust their new valuations. Right now, we might need another week for this to update. But you can see that in the chart, it just went up exponentially. And with the stock market being overextended, it becomes like a pretty dangerous time to invest in any stock. If you want to put a new position in, usually we want to put a new position whenever the stock market's oversold and they're worried about a debt ceiling or whatever they're worried about. But right now we're just floating on this overbought territory. Doesn't mean we can't go up here and break out of this and make a new pattern. But it seems like for a long-term investor, you just have to use these charts just to temper your emotions and know we're in a pattern. I think this is a great hobby for engineers because we're trying to find patterns and we're trying to follow some rules that have been successful in the past. And the only hard part about it is, in engineering, they don't teach you about the management of fear and greed, and you have to temper your emotions and just look at the numbers and try to use those to guide your decisions. All right, so now where are we here? Okay, so I'm going to talk about a couple things here. Let me see. Okay, so right now we're 78. So if you look at our stochastics, when it gets to 80, that is overbought, and we're right there right now with today's move. So right now we're near prior resistance too. So if we look at the S&P, with the chart full screen, it's up. Yeah, S&P is up a lot today. All right, so what we're looking at is the long-term chart at the S&P. Right now, you can see that this is prior resistance. We're actually there right now. At the top, we see this is August of 22. So a lot of times, prior resistance, a lot of the stock market participants might see that and say, well, that could be a limit to where we go up, and then we go back down, and that's how. And then the next step up might be here. It might be here as the next step up, and then whatever we break right here, that is the prior highs of January last year. Last year. Then we know we're on our way to basically resistance from the past, because this is an all-time high. So right now we're in an uptrend, and it looks like we're in a new bull market that started right around here, October of last year. So that's great for the stocks, but it seems like we're in this pattern where we can go down another 5% in this zigzag pattern up. So temper your emotions for that. All right, so now what else we have to talk about? Okay, oil. Whenever oil prices go up when there's a strong economy. When we had the job market very good today, we had a lot more jobs created. That's an indication there's a strong economy. And a lot of times oil goes up when the demand for oil goes up. And when there's a strong economy, people use more oil, and that's the way that is. And let's look at the numbers from CNN pre-market. This is like an awesome place for everything you need to know for inputs into the stock market. One is the crude oil went up 2.4%. That's probably because of the economy, the good jobs report. And we see the euro dollar. Okay, we don't think about that. Right now, when people are greedy, I guess everything speculative goes up with it. So right now, cryptos are going up. We try to avoid that. And the other things we get from this, okay, we don't get anything else from that. All right, so dollar index is not really going much. It's down 1% from last week, but I think the debt ceiling has a lot to do with what the dollar is trading at, and that was resolved recently. Gold is an alternative. Say if we have some kind of crash in the stock market, say if we have a debt ceiling that might be, we default on our debt in the United States, something like that, people were buying gold to protect against that. Now gold goes down because that isn't a problem. That could be why.
Before you move on from oil there, I know the U.S. government has said that they're going to be buying oil at around this price from like $67 to $72 to refill the strategic petroleum reserve.
Yeah.
So I think that's also going to help put a floor on oil prices. I don't think we're going to see much below 67 for quite a while.
I didn't think about that. Actually, there was a lot of pressure for the United States to start filling their petroleum reserve, but they didn't have the money. There wasn't a budget.
Yeah.
And all of a sudden, we have a budget that could be signed. I don't know if it was signed into law yet by the president, but as soon as that happens, the price of oil will probably go down, because if you take more supply off the market to fill the petroleum reserves, then the price goes down. So that's interesting. So maybe next week we'll see it down 5% because of that. So the oil is almost one of the hardest commodities to predict, because there's so many factors. It's illegal, but the OPEC controls the price, the supply, that goes on the market, and then you have all kind of factors like how the customers use the oil, and then the geopolitical issues, and then but I guess we have to keep it simple. If the economy's doing good, the price of oil goes up. That's exactly what happened during the pandemic, and the price of oil went down to almost nothing during the pandemic when no one used oil. And so I think we'll keep our eyes on that economy and the jobs report, and the economy's doing good, and the price of oil kind of follows that.
Yeah. I don't think it's going to go. I don't think oil's going down, very far anytime soon. So.
Okay, let's watch that. It's one of the biggest inputs to companies' costs for delivering the goods, for making the goods. Like Procter & Gamble uses oil for a lot of their things they sell, plastics. So, all right. So that's good. But if we look at the top 10 sectors, the reason I brought this up is look at this. The top 10 sectors, we have oil services, ETF, up 5%. That's pretty amazing to me, with oil only going up 2%. Maybe that's because it might be with a strong economy continuing throughout this year, we'd have a high demand for oil, and the oil servicing, creating new, drilling new wells or something like that. I'm not sure, but anyway, that'll explain that. But why metals and mining are going up, I'm not sure about that. Maybe the price of gold. Metals and mining, what do these things have in common? Retail. I guess with the strong economy, people are worried until now that we're going into a recession. If there's a recession, people aren't spending money. That's retail. People aren't buying houses. That's home builders. People aren't making new homes, construction. So whenever the job report came out, it basically said we're not going into a recession. Or the chances of a strong recession go down a lot. So that's why a lot of the consumer oriented stuff, like oil. Let me see. Oil is how much is used, and let me see. Home builders. Okay, so it looks like home builders could be going up because of the interest rates. I'm surprised that home builders is going up, because if the job reports they say it's a strong economy, then the Fed is going to raise interest rates, and that's not good for home builders. So that's very surprising, because people spend more on mortgages if you have higher interest rates. All right, so what else is going? Let's look at what's going down the most. Gold miners. Okay, so everyone was betting that there would be default, and there'd be a large demand for gold around the world and that never happened. So people are selling off the gold-rated ETFs. Okay, that makes sense. Technology isn't doing great today. That's surprising. We see a huge rally in the stock market. That's very surprising. I wonder why. All right, so let's look at some of the individual stocks. Market movers. Let's look at. Okay, add. All right, so we had a news story today about Amazon possible getting into phone service. So they could be a direct competitor to Verizon, AT&T, T-Mobile, and that made all the telecom stocks go down. So we haven't been watching Dish Network. They're one of the worst networks in America. They have one of the worst bandwidth. I'm surprised that Amazon would partner with them, but maybe they might buy some more network bandwidth for them to make a real network, but the quality is not there. So, if you see a T-Mobile go down or AT&T go down, the quality is not as good. Eventually, people will switch to Amazon and find that they can't make a phone call where they want to, and then they'll switch over. So this is like a no-op, I think. For Dish Network, it's great, to partner with Amazon for a new phone service, but in reality, T-Mobile has the best service. So, and AT&T and Verizon are already losing customers. Just think if Amazon gave a real good deal to people to switch and they lost more customers, that'd be really bad. We've already been saying AT&T and Verizon are going down because of losing customers. So that was the big thing that happened today. That's why the telecoms are in the top 10. 3M is up. I guess there could be some kind of resolution to some of their. I wonder what the news is for that. There could be a resolution to that ongoing problem with. I think they had some lawsuits. That's usually the only reason why companies go up a lot that are big like that. These are all stocks that are. I guess the thing that is in common here, they do good with the booming economy. So people are going to go to Las Vegas, spend money, go on trips whenever the economy's good. So we have two of those stocks. We have lithium. We have Black & Decker. Okay, housing. Black & Decker would be up because of maybe there's a strong demand in housing for building houses if the economy is good. The ones that are doing the worst, Constellation. Okay, we have. Okay, Constellation Energy. We have energy stocks. NVIDIA is going down a little bit. So a lot of times, whenever a stock like NVIDIA goes up 30%, and you have what's known as they go up until all the buyers have exhausted themselves. Then it starts going down. So I wouldn't be surprised if NVIDIA, has peaked in near term and starts going down a little bit. And all these semiconductors that are going down with it, that went up with the 30% move in the stock last week. So that's like I think traders have a saying, feed the ducks. So whenever the stock goes up, all the retail buyers start buying the stocks that are going up, and the real smart traders are selling to the ducks that are getting that little increase in price. And now all the sellers that made the money in the stock have sold, and now it's starting to go back down. But for me, I'm a buy and hold person, so I don't really pay attention to short term in buying or selling. Okay, so let's look at the NASDAQ, what's going up the most. Lululemon. We followed this stock before, and we noticed it was down a lot, and we looked into it. I think a couple months ago we said it was overvalued. The problem with Lululemon, there's three problems. One is recently, like last year, they had a problem with shipping. I mean, it was just super expensive to get stuff over from China, and they resolved that in the most recent quarter. they had a work from home. They were like a poster child for work from home because everyone wanted to be comfortable, when they're working from home. And so they really increased their sales at that time. What I did was I went through their information. They had a really good earnings report. They said China sales are growing. Let me see. There's been, like I said, a lot of different ups and downs in retail. Like Dollar General went down 30%. There's like winners and losers in retail this week and a half. And right now they're defying the trends for a more cautious consumer. And the consumers are willing to pay like $50 to like $100 for just, leggings or something. It's just amazing what they pay, but they love this product. And they're starting to do this website and app buying direct to customers, so that's going to help over time. But what most analysts are looking for are this profit margin and a return on equity. So that's like a margin, what they make on each sale, and that's been let's look at that over time. This return on equity over time is it was 36 during the pandemic, 38, 36. So analysts are looking at this profit margin as the main thing about this stock. And right now it seems like it's still overvalued by a lot of these companies that are following it. But they're getting better. It's the ship now. But there's a steady demand. And what I did was I looked at their year over year. They're only grown at 14%, but it's pretty consistent, 14%. So I guess if you look at their current price, if you divide the price by 2, their forward PE ratio is 32, and they're growing at 15%. So if you divide their PE ratio by what they're growing at, that'll give you, they're overvalued by 2 times. So for me, I'll wait for Lulu to drop in half, and then I'll start buying a position in it. But let me see. All right, so that was an interesting diversion. But they're the top 10 right now, and retail is. It seems like with the strong jobs report, that means that people and customers will be still buying this product. That app, their good earnings report, they'll allow this stock and other. You see, no, just that. There's no retail in the top 10. I would expect if one stock like this goes up, a direct competitor is Nike. I would expect them to go up with it, but they didn't, because Nike sells leggings and apparel also in the same kind of genre. All right, so what else is going up? We have Zscaler, Datadog, Airbnb. What do these things have in common? No, nothing. I don't see anything in common. But Zscaler and Datadog, they're kind of cloud-oriented, and/or Zscaler does antivirus, but they're related to that in that category. And Tesla, this is a stock that's playing catch-up. If we look at our stochastics, we notice that Tesla updates this every week, the stochastic charts. Let's go back down. Let's go down to Tesla. Let's go back to the bottom. Okay, we can see that it's been in a downtrend for a long time. I mean, this is what farther than any other big tech stock, but it's starting to break out right now. You can see that we had this lower highs, lower lows. This is one of the last tech stocks that is recovering from the big drop last year. And you can see it's just starting off. It's starting out to break out of this downtrend. The black lines are downtrend, and so today it's breaking out of that. And there's a lot of people probably seeing that and realizing this is going to be going in higher highs and higher lows. So most of the big tech stocks this year started way back the beginning of this year, the uptrend. So, all right, so we're gonna follow this. I think Tesla has a lot of catching up to do with the rest of big tech, and recovering from the big losses from last year. Okay, what else we can see? What else is in our top 10? T-Mobile, Sirius. Okay, so Marvel, a lot of these, NVIDIA, these are all related to the big run-up in AI stocks, any kind of semiconductor stocks that had a lot of times whenever one company, like NVIDIA, went up 30%, all the related stocks that feed into that or related to it go up with it. And now, there's a little less enthusiasm for that, and people get into other things. All right. But one stock that went down a lot was Capri Holdings. I was surprised. This is related. It's apparel. They make Versace and Michael Kors, so it's really high-end retailer. But it isn't let's look at that. So it's almost like, okay, so it's going up a little bit today. They had a major drop. Look at that. That was in beginning of this year, February, and they had another drop, like yesterday, went down to 35. Let's look at that. Let's look at the long-term chart. You can see that there's support right here, right where it's at right now, going back to 2022, May of last year. And you can see that there's also this resistance right here at the same level. So past resistance becomes support, they say. And so right now, it's basically Capri Holdings is at, kind of support from the past. But let's look at I like to see the top losers of the day, because that gives you, we started following this a while ago, and as one of the 5 or so apparel stocks in that are higher end. So let me see. Let's look at the statistics for Capri, just for fun. Okay, so look at that. We were on the ball, looking at this right now. The forward PE is 5 for usually stocks like that are higher end, Versace, Michael Kors, or Coach, or that's a different company, but Coach, or they sell for a lot higher than that. But forward PE is 5. The PEG ratio is 0.87, so they're 13% undervalued. They have all the numbers we're looking for in return on equity, profit margin. So they basically they make high-end materials and they have to sell it through Macy's and other companies, maybe some direct to consumer. But let's look at their each trade. Let's look at their earnings estimates. So let's see. Not allowing me to look it up. There it is. Okay. Let's look at their earnings estimate. So I'm expecting it to be, the earnings estimates to be better than 5%. Let's look at that. So they say that the PE is 7. Okay. So that's close to the 5 we saw in Yahoo. So I expect them to be growing at 5%, in their earnings estimates. Let's look at, we divide 6.17 by 6.87. That's 10% from, I missed that. From 24 to 25, there's almost no growth from this year to next year. I'm not sure why. 6.3 divided by 6.17, that's nothing. Okay. So that's 10%, 6.84 divided by 7.51, 9%. Okay, so it's growing around 10%, let's say. So it's half undervalued right now, according to our projections. So I guess what you have to think of is how the for this stock, how strong is it a brand? Is Michael Kors and Versace, are they strong brands compared to their competitors, and can they retain some kind of moat over time? That's the tricky part. Right now, you can see that during the pandemic, we had a negative earnings because they couldn't sell as much whenever things were shut down. That's like almost every company had a problem there. But I guess I can't log into Merrill Edge, but it'd be nice to go back and review all these higher end clothing companies. It seems like this one's undervalued, but the only problem for someone like Warren Buffett for investing in this, it's not very consistent. Like it has negative earning surprises, and it's not consistent over time. You're at the mercy of the demand of the consumer. So right now, I think it's undervalued. But I'll have to research that later on. But that's the kind of thing you get from these top 10 market movers. Maybe the company is just starting to come back, and maybe it's thrown out with the bathwater, as they say. All right, that was a good exercise. But whenever a company like Lululemon goes up, other apparel stocks go up with it. This went up 12% or 15%, and so it brings up the Nikes, the other companies that are competitors. All right, so all right, I already went over this a little bit, but the good thing about Lululemon is they're increasing their earnings over time. It's pretty consistent. You can see during let me see. Yeah, so in the PE ratio, you can see that Lululemon has traded at a really high PE ratio for at least the last 5 years. And now they're a little bit more reasonable, but they're still overvalued. But you can see that if a company trades for a premium, there's a good chance that it has reliable earnings over time. So Warren Buffett Warren Buffett used to buy companies that he called them cigarette butt companies. They sell for more than they're worth. But right now, Warren Buffett's switching to having a more consistent earning stock over time. They have a moat, or they have this consistent revenue over time. Let's look at, so the PE ratio is basically half, or just it's still high, so it's still a little overvalued. But when it goes back down in price, we can look at it again. Oh, let's do a little exercise. Morningstar says they're 33% overvalued right now, so that kind of matches some of our conclusions. Okay, so let's look at I'm getting close to the end. Let's look at some more of the liquid sector. Does anyone have any questions or stocks you want to go over?
I think that we covered the ones I was interested in before.
Oh, right. Nice. Let's look at some more news on the Yahoo Finance, one of my favorite places to look for stock news. Oh, I forgot. We can also otherwise jobs report shocks economists. It's like, okay, accelerated China sales growth. That news right there. Any company, when you see a news article where Lululemon is helped by China growth, you have to look at you have to have in your mind what percentage of every stock, what they count on in China for sales. Like, for instance, Apple has a good number of their, the growth in China. Also, Nike has, they're growing in China. If Lululemon does good in China, then there's a very good chance that people are buying Nikes too. So you probably can see Nike up today with that news. You see, is 5 million enough to retire comfortably at 60? do you think, Matthew?
Unless your ongoing housing costs are quite high, then that seems like enough.
Yeah. All right. Yeah. Sounds good.
Downgrade your house.
You see, we already talked about Verizon and AT&T shares slumping on reports Amazon to offer wireless. That doubles down on bad news for AT&T and Verizon. We've already been following that as a stock to avoid, basically. But I mean, they're probably going to cut their dividend if Amazon has any kind of growth. Whenever Amazon gets into an industry, every company is fearful of that. And they started getting into healthcare a little bit. They started getting into just totally different sectors, and they took over. And it's just another main reason not to buy AT&T and Verizon. Sorry, Mark. Mark doesn't like it when I bash his AT&T.
There you go again.
Let me see what else. Yeah. All right. Let's look at the stochastics for the stocks we're following. Now, after the week, and let me see. So S&P, seems like we're starting an uptrend here. We're kind of breaking out of a possibility of a sideways. We could remain in the sideways pattern for the rest of the year, and almost every stock we're following might follow that. But we have to keep track of our earnings estimates, and if they increase and we have a strong economy like the job market said today, then there's a chance we're going to be breaking up into these higher highs and higher lows and not these sideways moves. You see QQQ. It is definitely breaking out of this sideways pattern. So it's the first major index to break out of that. So the next step for QQQ is most likely down here and up here. We have a lot of momentum in the big tech stocks, and that's a big portion of this index. You see, defense isn't going anywhere. I don't know. Can't say much about this. It's like a sideways pattern, near term and long term. So I guess all the excitement around, possibility of countries gearing up for a war, and it's kind of gone down. Let's look at the gold. Right now, it's at the bottom end of its, upward channel. I think, I don't know. It seems like there's more certainty in the stock market with, earnings coming out really good with NVIDIA, and people most likely without a debt crisis this will start going out of this range again, and it'll be but we'll see. The one thing about gold is if we do have high inflation for extended period of time, gold retains its value over time. So there's some people that say a portion of your portfolio should be in gold. As long as the United States has the dollar going down on a regular basis, this will be something to counteract that. I don't invest in it, but that's the theory anyways. Consumer discretionary, it was sideways last year, and it's pretty much sideways this year. We'll see. We'll keep our eyes on that. Material sector, I guess. Not sure why this would be going down. I guess the dollar is going up, so the dollar has recently been appreciating. So let's look at the dollar. Yeah, I thought there it is right here. So the dollar, no, it's still continuing to go down. This is a year chart. It is basically at an all-time low. So when the price of the dollar goes down, the price of commodities go up. So it doesn't make sense why that would happen, but okay. Let's look at communication services. Okay, we're basically going sideways. Right now with the telecoms going down, it's probably going to be stuck in this range sideways for the rest of the year because there's no momentum at all in that sector, and it's starting to go down out of that channel. All right, so healthcare, this is one of the loser sectors of this year. With all other stocks going up, maybe 10% or more, most of the healthcare stocks were conservative last year. They were doing really good. They paid dividend. They're growing in a reasonable way. But right now, it seems like they're being sold off for the tech stocks, the ones that are doing good. So almost every stock we're following right now, they're in this industry are going down. So I guess they're out of favor. So I guess we have to wait until another questionable time in the stock market to really